SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF Baffi Bocconi e-lecture on key takeaways from the ECB's new Financial Stability Review. Energy and commodity price shocks amplified by the Russian invasion of Ukraine have weakened the post-pandemic economic recovery, both in the euro area and globally. At the same time, so far mostly due to supply cost push shocks, inflation is soaring. Euro area sovereigns, corporates and households, after having just weathered the challenges from the pandemic, are facing new pressures that could test debt sustainability for the more highly indebted groups. While banks have shown striking resilience to the pandemic shock, the probability of credit and interest rate risks materializing has increased. Market functioning has been largely orderly during recent volatility, but major price corrections are already happening and have happened since the start of the year. So what are the risks of further corrections? Non-banks, while having been effectively shielded from the pandemic, are now exposed to duration, credit and liquidity risks. What might the global normalization of monetary policies amid the economic slowdown imply? This morning, the ECB released its latest Financial Stability Review. We are privileged to have key makers of the FSR with us today. John Feld, Deputy Director General for Macroprudential Policy and Financial Stability, and Tamarah Shakir, Deputy Head of the Systemic Risks and Financial Institutions Division, both from the ECB, will present key findings. Then, Stefan Avdjiev, Advisor for Financial Stability, from the Monetary and Economic Department of the Bank for International Settlements, Patrick Darlap, Head of Division, Integrated Financial Markets of the Financial Markets Authority in Vienna, and Ranjit Singh, Assistant Director, Global Financial Stability from the International Monetary Fund, will discuss the ECB's assessment and bring in perspectives of their own. Without further ado, John and Tamarah, over to you.
Thank you very much for that, Ernest, and good afternoon, everyone. So let me say on behalf of Tamarah and myself that we'd like to thank you, Ernest, and the SUERF board for inviting us back yet again for, I think, the fifth time now to present the highlights of our May 22 issue of the ECB's Financial Stability Review, which, as you mentioned, was just published this morning. So last time in November, you might recall that our message was one of both good news and of bad news. At that time, while adjustment to a global supply side shock had given cause for financial stability concern, we were also hopeful that we would soon be emerging from the restrictions imposed by COVID-19. And since then, of course, as you mentioned in your introduction, Ernest, geopolitical risks have come to the fore, and we are now having to deal with the consequences of the Russian invasion of Ukraine, which has had unspeakable humanitarian consequences. And it has also blighted a financial stability outlook that was already impaired by higher than expected inflation and a loss of economic growth momentum. So I'm going to run through our assessment of the sources of risks and vulnerabilities for financial stability, and then I'm going to pass to Tamarah to explain the macroprudential policy implications, as well as providing some color on the two special features that we published in this issue today. So on this slide, we have our main message, and as you can see, it's not an upbeat one. Financial stability conditions have deteriorated since November, and this is for several reasons. We got four listed on this slide. First, and this was part of the bad news, I guess, that we had already in November. Before the invasion, we had concerns about the building up of vulnerabilities in financial and housing markets and on private sector balance sheets as well. Now, as the war has led to a higher inflation and lower growth expectations, so that's basically it's a constellation of triggers that we had actually feared the most, but from a financial stability perspective, many of those vulnerabilities have been amplified. And at the same time, and second, we had been saying for a long time that financial asset prices, chiefly equities, but also corporate bonds, especially lower grade corporate bonds, were difficult to reconcile with the fundamentals. And now with interest rates rising, both long-term and in the US also short-term, those fragilities are being exposed. A correction is now clearly underway in the US equity market, and it has spread and spilled over to the euro area markets as well, as we've seen. Now, third, after the stresses that the COVID-19 pandemic imposed on basically all non-financial sectors, rising interest rates and input costs, especially energy, but also non-energy commodities, are likely to test the resilience of balance sheets. And then fourth, different to what many analysts might have thought at the start of the COVID outbreak, the banking sector has remained remarkably resilient, and profitability has recovered strongly. But when you look at it in international comparison, not as strongly as in the US. And so we have, I would say, kind of a deja vu on the banking sector outlook. While we do think that the sector will prove resilient to the fallout from the war, and we have analysis in the FSR showing that, arguably we are also back to where we were in late 2019, with low profitability again front and center as a source of risk for financial stability. So the rest of my part of the presentation is going to run through these elements, these 4 points, in a bit more detail. So if we go to the next slide, the chart on the left here shows that the consensus among professional forecasters now is for lower growth this year and for higher inflation than was the case just 6 months ago. And not only that, forecasters seem to be more certain about this, with a narrower probability distribution for growth. And then you can see for inflation, it's in the middle there, the two distributions, so the one in November and the most recent one, they don't even overlap now. The war and its knock-on effects, and that's of course through the sanctions, etc., on energy and other commodity prices, were an important driver for this supply side shock, but it was not the sole driver. And if you look to the left of the vertical line labeled invasion on the right-hand side chart, you can see there both energy and other commodity prices had actually been rising strongly well before the war. And that was, of course, because aggregate demand was increasing. And that was what we were starting to get concerned about already back in November. So even without the war, slowflation, as some people call it, was becoming an issue for financial stability. So we go to the next slide. Let me go through this one in reverse order and start on the right, because this chart really underscores the chief new concern, a distinguishing feature even of recent commodity market developments. With concerns of global shortages, commodity prices surged, and that created risks for commodity derivatives traders, also real economy energy producers and other commodity market participants. Now, they're aimed at mitigating market risk for the clearing members that energy firms will transact through. I'm talking here about initial margin requirements. So that's the collateral that when you enter into a position in the commodities derivatives markets that you need to post on entering a contract with a clearing member of a CCP. And you can see there, it's in yellow, those initial margin requirements surged on natural gas futures, but we saw the same pattern across a host of other commodity markets as well. And so, and that's against the background of the surge of absolute price changes. So that's in blue. You can see that there's a correspondence between the two. And so what we saw next was an impairment of market functioning because these requirements reportedly reached prohibitive levels where, say, an oil company that would want to sell oil at a pre-agreed price in the future, so effectively it needs to take a short position, it couldn't do the trade because it may not have had sufficient collateral, despite, by the way, having the commodity, owning the commodity. So open interest for commodity derivatives on organized exchanges was eroded. It's not on the chart there, but it is in the FSR. Now, while it might seem like this reduced risk, I mean, our conversations via what we call market intelligence, so with people who are participants in financial markets, revealed that some energy producers decided not to hedge, while others shifted their activity from one CCP to another, and then others even moved to the OTC markets, and where we know risk management standards are usually lower. Not only does this create counterparty risk for the banks involved, but the drying up of liquidity also makes the market itself more prone to volatility and adverse feedback loops, in our view. And of course, while all of this was going on, we had more broad-based market reactions to the war, with stock markets tumbling, as you can see there on the left, corporate bond spreads widening. Although, and you can make the comparison there, to nowhere near the extent that we saw at the beginning of the COVID outbreak. Now, if we go to the next slide, and sticking with the theme of disorderly market dynamics, we saw the usual pattern almost always seen during episodes of market stress: safe haven flows to the US bond market. So you can see that there in light blue on the far left, but also inflows to asset managers specializing on euro area inflation protected bonds. And then at the same time, corporate bond funds, so that's both US and euro area, suffered outflows. And then if you look at the middle chart, equity funds, there were outflows and inflows depending on the exposures of those funds. Equity funds that focused on businesses that stood to benefit from higher energy and other commodity markets drew inflows. Now, importantly, these flows were in the main orderly, and we didn't really see suspensions on outflows, except, of course, for Russia-focused funds. Now, that said, as we've repeated many times before, we continue to see vulnerabilities building up in the euro area investment fund sector. As seen on the right, we've got their measures of both duration and liquidity risk. One line is going down and one line is going up, but they're both saying that the risks are increasing. The liquidity risk increasing, so the cash holdings of funds declining. So that is a measure of the ability of funds to say honor unusually large redemption requests if they were to come. That's declining, and that's becoming an increasing source of concern. And then, not shown on the chart, exposure to credit risk has also been increasing amongst investment funds as they've moved down the credit quality spectrum. Now, if we put all of that together, we continue to consider it plausible that the sector is vulnerable to the type of forced selling dynamics that we actually saw at the start of COVID, should it be overwhelmed by a shock. Now, if we move to the next slide, and beyond the market dynamics, we also see potential for rising credit risk in the corporate sector. Now, the left chart is plotting some scenarios that were produced by Moody's for default rates on speculative grade corporate bonds. Actually, 2 years ago, at the start of COVID, Moody's produced charts that looked very similar to these, and I think we all found them plausible at the time. But maybe with some humility, at least on my part, let me just say that we got that one wrong. The question is, why did we get it wrong? My view is that we didn't fully understand the potency of an instrument that had never really been used on a mass scale before, and I'm speaking here of government guarantees of firms' liabilities, which were used widely across the euro area. Now, those programs have largely lapsed now, and the sector has since been confronted with a new shock, the war in Ukraine. So if we just take the baseline, so that's the yellow lines on the left-hand side, by the end of this year, Moody's is projecting sub-investment grade bond default rates to be double what they were at the start of the year. And then if you look at the red lines, the most pessimistic scenario, you're seeing a sevenfold increase almost. And at this stage, well, our view is that the impacts, both across sectors and across countries, of this of the stress caused by the war is likely to be heterogeneous. So the chart on the right is our attempt to identify those sectors that have suffered what I would call the double whammy of both the COVID shock, which caused turnover in some industries to collapse, as we know, and then also finding that their businesses have larger than average exposure to energy inputs as well. So the sectors that are hit by both are in the red shaded area, and you can see well, the usual suspects: air transport, food and beverages, textiles, and then accommodation very much on the vertical line there. And you've got a number of others sitting very close to the vertical axis. Now, if we go to the next slide and the issue of sovereign balance sheets, after the COVID-induced accumulation of debt, it was well known that a scenario of weaker growth together with an inflation shock, or again, as I said earlier, slowflation, could expose sovereign vulnerabilities. And now we're also seeing increases in budget deficit projections for the vast majority of euro area countries. And that's contrary to earlier expectations that we would have seen some normalization after COVID. Now, as you can see on the left, with asset purchases coming to an end. Well, that's not shown on that chart, but we know, I mean, it's been widely communicated, with asset purchases coming to an end and monetary policy interest rates expected to rise. We're now seeing a widening of spreads, sovereign spreads in the euro area, and you can see there by more in countries with high debt levels than in countries with low ones. So the high debt level countries are the ones in yellow, above 90% debt to GDP, and then the low ones below that. The slope is also different there, as you can see. And we're also hearing so-called fragmentation risk coming up in our market intelligence discussions more frequently than was the case 6 months ago. But then mitigating factors. We know that debt sustainability risks remain mitigated by reduced rollover risk, as governments did take advantage of low rates to extend their maturities. And then, I mean, we need, when we look at the impact of inflation expectations on the position of sovereigns, and we know that it has played some role in the widening of spreads, we still think it's important to avoid a partial view, and this is what we've done in the FSR. So, for example, higher nominal GDP will, of course, mechanically offset increasing debt and lower real GDP growth, but we're emphasizing more the impact on real debt servicing ability, and we explain this in a box in the FSR. And it's a bit more ambiguous because we've got positive cost shocks, higher government expenses, and ambiguous revenue effects in the near term, while we know the funding costs are rising. But we made an attempt to put it all together through economic models. It's done there on the right, and you can see that higher interest rates, especially in a context of weak growth, so that's the scenario there, the red lines, could pose risks to debt sustainability. There is the added concern that higher debt also means that governments have less fiscal space than was the case at the start of the pandemic. And of course, that limits in turn their ability to cushion the impact of energy shocks on businesses and households. So even though so far the widening of spreads has actually been orderly so far, but past experience has shown that non-linearities tend to appear when they are least expected, and so that makes us cautious on this risk, let us say. Now let's go to the next slide. And households, the main vulnerability here arises from the interaction between rising house prices, rapid mortgage credit growth, and now the potential for a squeezing of household disposable income given higher energy prices. You can see that there on the right, the last point there on the right, where we show the percentage of monthly income that is spent on energy and food depending on the income quartile. And you can see that for the lower income quartiles, shocks to this key component of consumption could induce hardship on people on lower incomes. Now, signs of overvaluation in the housing market had already been rising through 2021, and I'm sure we spent some time on that in our last presentation. Now the latest data for euro area aggregate data is showing the highest rates of price inflation in 20 years. Of course, euro area aggregate data only exists about 20 years, so the figures could be larger. But this is just using euro area data, and of course this is partly driven by it's on the chart on the left. It's partly driven by increases of construction price expenses. So there is a supply side element here, but we also cannot exclude that we may be entering into a dangerous house price credit spiral. In fact, I think that seems to be the case already in some countries of the euro area, and the ECB, as you might know, has been issuing warnings to countries that have housing market vulnerabilities, and they've been doing so over the past year. Now, while countermeasures have been taken by countries, at an aggregate level, we still see risks of price reversals in the market, and we think that there is the potential for those reversals to amplify and propagate economy-wide shocks if interest rates and income squeezes were to cause defaults to rise, or if it were to lead to a consumption squeeze, which, as you can see from what I was showing on the right, that is a plausible scenario. Now, there are two big mitigants to this, however. First, the financial condition of households is generally strong in the euro area. We still have low unemployment, and of course, we have all of those savings that were accumulated during the lockdowns. Second, fixed rate mortgage lending is more prevalent in the euro area today than it was a decade ago, and that has shifted the interest rate risk to the banks. It's a point that I'm going to come back to in a moment. Now, if we move to the banks on the next slide, as I already mentioned, there has been a striking recovery in profitability, with the aggregate return on equity almost exceeding pre-pandemic levels, and market valuations have risen. Now, while the banking sector equity was hit harder than any other sector by the shock of the war in Ukraine, it proved to be short-lived. You can see that V there around the end of, towards the end of February on the chart, and actually all bank stocks basically across the world suffered the same shock. Now, you can see that it also proved to be short-lived, and that, I think, confirmed at least the market perception of a generally resilient banking sector. Now, that said, price-book ratios remain significantly below 1 in the euro area. This means that banking business in the euro area is value destructive at the margin, that the return on equity is lower than the cost of equity. And we were saying that before the pandemic. And we do think, even though banks usually benefit from a steeper yield curve, this could be outweighed by lower than expected growth going forward. And then at the same time, the shift from floating to fixed rate lending brings the concern that some banks that are currently funding low yielding assets, so mortgages, for instance, profitability improvements may actually not be possible to the extent that they're funding long term. So the possibility, I think we remain with this low profitability issue, we think. So I'm going to stop there and hand over to Tamarah to finish the presentation off.
Thanks, John. So I wanted to just wrap up with a couple of highlights on 2 special features in this financial stability review, and also on our policy messages as a result of the risk assessment. We have 2 special features, as I say. The first one is on the topic of climate-related risks, and it's our 3rd special feature on this topic, and the FSR, as we increasingly have now trying to normalise, as it were, where this topic fits in financial stability risk assessment. And on the slide here, what we've done is gone back to discussions that we've had in recent issues around transition risk, and then also looking at the development of financial markets. And what we find is that in general, the exposure of both banks and non-banks in the euro area to high carbon emitters, so those that would be most exposed to transition-related risk, remains relatively elevated, which is what you can see on the left-hand panel here. But what's more, it isn't showing consistent signs of declining significantly enough, and so we remain concerned that we're not seeing that decrease or the shift in the carbon footprint of the portfolios. More positive news, though, does come from the market side. So, as it were, green or sustainable financial markets have been expanding quite significantly, and we see that clearly in the data. On top of that, we have seen progress towards disclosure, which is something that we think would aid the growth of these markets. So more disclosure around emissions targets from non-financial corporates would help with the development of green financial markets overall. However, as we analyse in this FSR, we do still think that the lack of consistent standards around those disclosure does mean that greenwashing risk is alive and present and needs to be addressed. And so we continue to advocate for greater standardisation and harmonisation in these disclosures. The next topic, the next special feature covers crypto assets. So we've had boxes in previous FSRs, in fact in the last FSR, on stable coins, so backed crypto tokens. In this FSR, we have a special feature on unbacked, I don't know if traditional is the right word, but the more commonly thought of crypto assets. And we pick up on a few things in this special feature. So although overall these are still relatively modest markets when you put them alongside core financial markets, they have been growing very rapidly. And what at the same time, their valuation is clearly still very volatile, and also increasingly we see that those valuations becoming correlated with valuations of other highly risky assets. So this disputes the idea that these assets can be used as some sort of diversification relative to traditional risky assets. They appear to be moving alongside that. From a financial stability analysis, though, we pick on a few themes. The first is the growth in the range of establishment type investors that began holding them. So there's a large direct retail holding aspect to this, we think. Data in this area isn't very easy to get hold of, but using a recent consumer expectation survey data, we get actually indications that possibly 1 in 10 of euro area households may have some crypto asset exposure, which is a number that attracts some attention. It's comparable to similar survey results in other regions as well. On top of that, there are signs that whilst many of those holdings might be relatively small, so you can see that in the pie chart in the middle here, there are also a set of holders of these assets who are holding much larger amounts. And when we corroborate that also with the fact that there's evidence or some signs in the surveys that tends to be younger adults who have more holdings of these, this may be a relatively large share of their asset base that's in crypto. On top of that, we also have growing evidence that institutional establishment investors are getting more and more engaged in this sector. Something like a majority in a recent survey of funds indicated interest in crypto assets. The number and range of crypto assets is growing. The number of exchanges on which they can be traded is growing, really at stellar levels. So we are becoming more concerned about the growth of these. The second aspect, in terms of not just the growth, it's also been the use of leverage and other related integration into the wider financial system. And that's something that we start to document on the right-hand side. So alongside the growth of crypto itself, we've also seen a growing number of exchanges offering futures, options, and other related derivatives contracts linked to crypto. And that, of course, then allows the possibility of synthetic leveraged exposure into crypto. So similar to any other derivatives, paying the margin to get exposure into the asset. And metrics of that kind of leverage estimates, so taking open interest over the coin reserve of the exchange, you can see in the right-hand panel some of the evidence, particularly more marked, I think, in, for example, in Ether than in Bitcoin, but these signs of increasing leverage into these sectors. We also see in the growth of other developments around margin lending or other forms of lending to allow exposure into leverage. So all of that adds up to a picture of a crypto asset ecosystem that is increasingly integrated into the wider financial system at a rapid pace. And for us, this really brings home the need to get on top of the regulation of this sector and sort of act, as it were, before it becomes a much more material financial stability risk. And that's a new topic for us in this FSR. Just to wrap up then, sorry, conscious of time, overall in the FSR, so John sort of painted this picture of a deterioration in the outlook in linking to pre-existing vulnerabilities. We've been calling for some time we've advocating the advantages that would be for the financial system for building resilience to address medium-term vulnerabilities. That includes supporting, for example, the ESRB type calls for action on specific markets like the real estate markets, but it also has been about enhancing buffers in the banking system, and particularly usable buffers that could be deployed in stress. We still think that is the appropriate direction of action. However, mindful of the uncertainty, we recognise that the exact timing and extent of deploying that needs to be sensitive to the uncertainty in the economy. I think overall our message, though, is one of sort of opportunistic action, given, for example, the available capital in the system that could be redeployed into buffers. The second dimension of our policy messages in this FSR relates to the framework, both the macroprudential framework for banks, where again, structurally, we think there's a case for enhancing the framework to improve the usability of buffers. And secondly, the macroprudential framework for non-banks. This has been a theme of ours in repeated FSRs, about needing to address the risks from liquidity mismatch and leverage in the non-bank sector. John set out there really the continuing deterioration in the risk outlook for the fund sector. And on top of that, we've seen in the recent months a need to link to margining practices. And we also have a box in this FSR that draws out not just the pro-cyclical risks, but also the risks that are arising from use of synthetic leverage in the non-bank sector, which is hard to regulate. So all that together, I think I can wrap up slightly over time, but here's the summary of our FSR overall. Thank you.
Thank you very much, John and Tamarah. We are now switching to our first discussant, Stefan Avdjiev from the Bank for International Settlements.
So I would like to first start by thanking the ECB as well as the SUERF webinar organizers for inviting me to discuss this financial stability report. And I have to say that the standard disclaimer applies, that the views are mine and not necessarily those of the BIS. Next slide, please. So my reading of the ECB Financial Stability Report is that it is a very comprehensive and a very thorough assessment, and I'm not using any of those two terms lightly. I really do mean that it is indeed comprehensive and thorough, and it was a pleasure going through it, which the flip side of that, of course, is that it made my job as a discussant a bit more difficult, because it's difficult to find areas to suggest when things are so comprehensive and so thorough. But it is a comprehensive and thorough assessment of the financial stability vulnerabilities and the implications for financial markets, debt sustainability, bank resilience, the non-bank financial sector, as well as macroprudential policies. The main takeaway, as we just heard, is not so bright, but it is nonetheless a fact that financial stability conditions have deteriorated along several key dimensions over the past few months. The key messages are that macroprudential authorities should continue to address vulnerabilities, adjusting for economic conditions in order to avoid procyclicality. Having macroprudential space and effective buffers will help smooth medium-term resilience, and this is especially applicable in the current environment of highly elevated uncertainty. That statement, I guess, applies unconditionally, but it's especially relevant at the current juncture. And then the risks arising from liquidity mismatches, leverage, and margining practices in the NBFI sector need to be tackled comprehensively. Next slide, please. So in terms of the main risks and vulnerabilities that are identified in the report, and here in the interest of time, I'm sure I won't do them justice in terms of going through them as comprehensively as possible, but just by way of summarizing them, the macro financial landscape is dominated by risks to growth, inflation, and financial conditions. These are elevated by energy and commodity price shocks, which are in turn amplified by the war in Ukraine. The stagflationary macroeconomic environment will put pressure on vulnerable borrowers across the board, you might say, in terms of all of the main sectors. So the debt sustainability of the more highly indebted sovereigns, corporates, and households in the euro area could be tested by higher interest rates and cost pressures. The war, as we just heard, the war will likely challenge fiscal positions, which in some cases are already strained. The rising input costs will weigh on corporate margins, and then house prices face correction risk, again against the backdrop of the current environment, combined with the current stretched valuations in some cases. Despite remaining resilient and able to support the economy, banks face a combination of increased credit risk and weaker profit outlook, which will make things a bit more challenging for them. And the risks of sharp corrections in financial markets are there and as present as ever. NBFIs seem to be most exposed to duration credit and liquidity risk. And then on top of that, some funds exhibit additional vulnerabilities from the heavy use of synthetic leverage. Next slide, please. So in addition to the main messages, as I said, the report is very, very rich. There are a lot of interesting details and facts and relationships that are documented and highlighted. Here I just picked a few of the most interesting ones. On the corporate side, some pandemic strained sectors are also highly exposed to to elevated energy prices. This was one of the graphs that we just saw. This is a really interesting and a really illuminating graph. It's again, if one thinks of the current conjuncture, it's in many ways defined by these back-to-back shocks, which were the pandemic and then the elevated energy prices. So there's a chart in the report which nicely puts those together and highlights which are the sectors that are hit by this double whammy. Something else that's also interesting and important to note is that corporate vulnerabilities are clustered in countries which tend to have both elevated sovereign debt and weaker banks. So that's definitely, obviously, an area of concern. When it comes to the banking sector, in addition to what I mentioned in the previous slide, Euro area banks' duration gap has widened. The report documents that, and this is increasing their interest rate risk, which again is really important against the current macroeconomic and policy environment. When it comes to cyber risks, the report also meaningfully highlights that there's been a rising number of global cyber incidents targeting financial institutions. And then what is a bit worrying against that backdrop is that Euro area banks lag behind their peers in terms of IT investment, which again, I thought it was, there's a really interesting piece of data, or a couple of pieces of data on that topic in the report. When it comes to crypto assets, which is one of the two special features in the report, interconnecting this with the wider financial system has been growing. Demand, again, the report has some interesting data documenting the demand from institutional investors in Europe has also risen. And then what I thought was also interesting was, again, there's another chart there highlighting that retail investors represent a significant part of the crypto asset investor base, particularly in some Euro area countries. And then the other special feature on climate change, capital markets, again, as Tamarah discussed right before me, capital markets remain susceptible to greenwashing. And what's again also interesting and important to know and note is that only the most credible green bonds seem to be benefiting from cheaper funding. So there's quite a bit of discrimination when it comes to that. Next slide, please. So in terms of the main risks and vulnerabilities, they're very much in line with what we at the BIS have seen and detected as a part of our global risk surveillance. Of course, the focus here is much more on the Euro area, but to the extent that there are large overlaps in terms of the focus or the sub-focus of the two exercises, they are very much in line with what we are finding. And this is what I meant at the beginning, that the comprehensiveness and the thoroughness of the report makes it difficult to be a discussant for such a report. Nonetheless, there are a couple of additional issues that may warrant attention that I would like to bring up now. One thing that we should not forget is the risk about a pandemic resurgence. And I know there's a bit of fatigue of analyzing the economic and financial consequences, but we should always be mindful of that risk being out there, either a resurgence of the current or past pandemic, or the risk of a new pandemic, and what that would mean, and what kind of a triple whammy that would be for markets and financial institutions. Another area is snapback risk, and the report actually discusses quite a bit the implications of rising interest rates, where I think a bit more could be done and analyzed is to distinguish between gradual increases and more sudden increases, which I guess is more what snapback risk is referring to with these, because the implications would be quite a bit different if there are sudden increases in interest rates. And then finally, when it comes to international spillovers, one can think of at least two types of spillovers. There's the inward spillovers, and the report has a box on China macro risk shocks, so that's already in there when it comes to inward spillovers. Another important one is US monetary policy shocks, which of course the report touches upon. In fact, even in the box as a part of the analysis, US monetary policy of course plays a major role. The focus seems to be on the China macro risks, where given the importance of U.S. monetary policy and U.S. monetary policy shocks, there could be inward spillover implications. When it comes to outward spillovers, one area which additional attention might be warranted is euro-denominated credit outside of the euro area, and in particular, as the extent to that relates to the financial channel of exchange rates, which most applications and most research and analysis on that channel has been on the US dollar as the main global funding currency, but actually the euro, as we all know, plays a non-negligible role, at least in certain parts of the world and in certain regions. And again, the financial channel of exchange rates, the gist of it is that fluctuations in the value of a global funding currency, like I said, most people tend to analyze the dollar, but of course in the euro too, affect the balance sheet of currency mismatched agents, not only borrowers, but also lenders, and then ultimately end up having an impact on cross-border flows to given countries or regions, and then they end up ultimately influencing the financial conditions in those countries and regions. And to continue on that note, next slide, please. On that note, I'll show just a couple of graphs which are using some data that we've put together at the BIS, namely the BIS Global Liquidity Indicators, which are combining information from the BIS International Banking Statistics on one side and the BIS International Debt Security Statistics. So these are put together in order to come up with aggregates of global liquidity, one of the most important one is euro-denominated credit to non-banks outside of the euro area. So as we can see here on the left-hand side, that metric has grown quite a bit over the past decade, especially in the latter half of the past decade. Not only vis-a-vis the entire world or the entire world outside of the euro area, but also vis-a-vis emerging markets. And then next slide, please. So this slide zooms in on emerging markets, on euro-denominated credit to emerging markets. As we can see, the amount of euro lending to actually all four major emerging market regions is non-negligible. Of course, it's highest in emerging Europe. So no surprise there. And then on the right-hand side, that we see that certain individual countries actually have quite sizable amounts of euro-denominated borrowing. And then finally, in my last slide, next slide, please. In my last slide, I have put together again another metric on the evolution of euro credit outside of the euro area. So the red line is total credit, and the blue and green lines are loans and debt securities or bond issuance respectively. And then the yellow line shows us the euro near. And as we can see that so if there are too many lines, we can just focus on the red line, and which is the total euro credit outside of the euro area, and euro nominal effective exchange rate. So as you can see, there's a clear negative correlation between the two lines. So when the euro is stronger, euro-denominated credit outside of the euro area tends to be growing faster, and vice versa, which is in line with the predictions of this financial channel of exchange rates. And I think I'm out of time, so I'll stop here.
Thank you very much. We now turn to Patrick.
Thanks for inviting me, and thanks for having me as a discussant. The headline here is Trends, the Cycle, and Stability. I think that's what we need to, we need to discriminate. So we do have trends which are quite clear. And on the other hand, we are looking at more cyclical events that take place, and where it's important that the financial sector, the market plumbing, as I put it here, is working. And then finally, we should ask ourselves, and we do ask ourselves, what stability implications all this has. And these are the issues that I would like to talk about in the upcoming few minutes. First of all, I think, even though everything is getting a tad tougher than it used to be, financial market plumbing is holding up well so far. So what we see is that price formation in general works well. Of course, there are some events in the crypto world, and well, of course, volatile expectations make the pricing of certain assets as volatile or even more volatile than that. But I think that's okay as long as price formation takes place and is working. And well, then there are some areas of liquidity concern regarding the exit of central banks in their current or out of their current position in well, kind of dominating a number of market areas. So tapering will have an effect, and well, this shouldn't be underestimated, because of course the normal working of the financial markets will need to well, to break through again, and well, this transition back to normality, if it takes place, is something that should be monitored. Well, credit supply is, I think, working well, and risk capital is still there, though it is more discriminating. And well, what has already been touched upon is the margin call stress. And well, I've got to praise the presence of data here, which wasn't the case during the last various crises, and so we are in a much better position now to know who is actually exposed. But what we don't know, and I'll come back to that later, is how the net position is looking like. And so, of course, it's a liquidity indicator, but well, when looking back some 15 years or so, if you were speculating on market developments, then of course this is something that hits you in a different way than if you're just hedging your positions, your long positions that you have. Well, the more trendy or trend style kind of issue that I've got here is the speed of globalization wind down. So that's deglobalization. I was just looking for the D. And this is one issue. The other thing is that well, at least in my perception, there is a certain decoupling of the monetary regions across the world. And this has implications regarding the deglobalization, which is taking place, or will probably take place, at quite a high speed. My question would be, is there a lot of sunk investment? Is it too much? Because, well, when adaptation is quite speedy, then yeah, you risk well, losing out on some investments that you have made. And I think the sanctions regime is, and the implications is a very good example here. And looking through the Austrian window here, well, we've got good examples there. And another issue is that apparently what we have seen, well, on a more slower pace, is how to cope with the inefficiency that is coming out of deglobalization. So the whole world is, as I perceive it, just getting less efficient, and you've got to optimize that. So and at speed, by the way, and therefore there are investment opportunities in onshoring. So there is a lot to fund and to finance, which may be a challenge. I don't really think so, but maybe a challenge. There is also the possibility that you get it wrong when investing in those onshoring opportunities. So a certain risk here. Well, so that's an issue that well, that might bring some future stress or future risks with it. Well, I think Stefan already touched upon the FX risk. So what we see, the euro well, depreciating at a speedy pace. And of course, this will have implications on probably also on credit risk. And I wonder well, how that looks like, I'm not sure that it's actually in the review already. But we may have to look at that in more detail in the future. And well, finally, regarding this overall topic, substitutability is an issue. And I think everybody knows you've got to substitute one thing for the other, which works, but it doesn't necessarily work on a short time horizon. And therefore, I would expect that there are some indirect effects through limiting production factors. Everybody knows about the chip supply problem. And we also now experience the gas supply problem. Well, all this may lead to cost convexity. So really strong cost increases. And in this respect, I would have one remark, and Ernest probably knows, when looking at energy intensity, you can drill a bit deeper and look at gas intensity, because that seems to be, at least as far as I understand the issue, something that can abruptly, well, be wiped out in terms of, well, for some countries at least, and for some industries, it's just not substitutable in the short term. And therefore, we've got an issue here that may go, well, beyond just some price increases that can be passed on. Well, then we got a trend towards ever increasing spending needs. Well, now recently we've learned that the Commission is willing to centralize the funding of various needs, not only the recovery from COVID, but now also investments in, if you can call it investments in weapons and so forth. And this is something where I would be interesting how rating agencies actually see that, whether there is a new channel for contagion. So all this may also test the funding, and that's part of the report, whenever liquidity in the market is reduced. So an interesting area there, or a new development. And well, I think I should have, yes, omitted the next one, the next line. So that's duplicating more or less the previous one. But now I come to the question, what financial stability worries do we have? So when looking at the markets from a financial stability perspective, you always ask yourself, is there something where, well, crowded trades will happen, or where people try to, well, to evade developments, like in the real estate segment? Are there hidden exits that we don't see? Difficult to say. Well, I don't know at the moment, but that's the big question. So from financial stability perspective, my worries would be that actually there is maybe more de-risking to come, and the corrections, as was stated, are extremely or eerily or orderly. So whenever there are corrections, they usually are not orderly. So maybe there is more to come, and not such a pleasant way. Then regarding interest rate hikes, the question, there is a graph in the report regarding the well, the counterparties of interest rate swaps, but and well, we've got this information, and we make the most of it, but it just gives us one side of the balance sheet. We don't know whether these interest rate swaps are hedged or not, and so there it would be interesting to learn who the ultimate unhedged counterparty is in this respect. It's probably well, it's impossible to find that out based on our data that we have, but that's the real question behind, I think. And well, a lot was said about variable rates over the past 15 years, I don't know, variable rates loans. And well, so this is something where certain countries, including Austria, the ratio of variable rate loans is still quite high, and as we see the world, it's better to have these interest rate risks on the balance sheet of intermediaries rather than on the balance sheet of households. Others may see this in a different way, but they are certainly better placed to manage interest rate risk here. And yeah, finally, inflation and nowhere to hide. So the question is actually, what can you do? Is there any asset that you can buy to hedge against inflation, with the exception of inflation-linked bonds? But regarding energy prices, you just can't move out, or you can't move away. They will hit you. Regarding safe assets, cash was mentioned. Regarding investment funds, that is something where you have to choose between market corrections on the one hand and inflation on the other hand. And bond valuation volatility is something that haunted us in the recent past. So difficult. So that is would be my worries here. And my final word is regarding the role of macroprudential policy, which recently, or since the onset of this kind of new policy instruments, it seems to have counted the effects, the unintended consequences of monetary policy. Now that monetary policy is probably no longer fueling growth in market segments, the question is what will happen, and therefore I'm quite grateful for the policy recommendations here and there, saying that money and capital profits shouldn't be spent, distributed anywhere, because we're going to see more problems. We've just encountered two of them. The next one is going to come, and we need to consider how macroprudential policy should look like in this environment. And certainly the FSR is an excellent basis for doing this.
Thank you very much, Patrick. We now switch over immediately to Ranjit.
Thank you so much, Ernest. Thank you very much. Let me, first of all, thank SUERF and Bocconi for their kind invitation to speak at this forum. And I'd like to also echo the comments by the other speakers and congratulate the ECB on another very prescient financial stability review, and for the very excellent presentation that John and Tamarah had made. Before I proceed, let me also caveat that the views that I'm expressing today are my personal views and don't necessarily represent the views of the IMF. Obviously, in many ways, some of the, many of the items actually that were identified in the context of the presentation by John and Tamarah were also reflected in the April GFSR that we had done. And that was very challenging, clearly, because of the fact that, we had begun, in fact, writing up the report. And just as we had been framing the report around inflation and how central banks would react, the war had occurred. And so that required a rewrite. And it wasn't easy because there was no obvious template that we could use. And whilst a lot of the financial conditions framework that we used worked, except that many of the vulnerabilities were not obvious in terms of the elements of the framework. So we had to really think about it from various transmission channels, which could be relevant for this kind of shock. And one of the most, obviously, the obvious one was around the commodity markets. And this, we looked at it from two angles. One was the macro angle, and how the problem faced by central banks, both in advanced and emerging markets, would be more complicated in terms of trade-offs. You have less growth, more inflation, more persistent inflation, making the trade-off much more complicated. But also, we looked at it in terms of financing, and this is again something that John had mentioned around the disruptions in the commodities markets for financing for banks. We looked at collateralized lending, and also around the derivatives markets and how concentrated the markets seem to be. And it wasn't easy to be able to get the kind of information that we wanted to, but we certainly flagged some of these issues, and including the concentration around the dealer banks as well as the energy trading firms. And we also talked about the interconnectedness with the LME being an example that was highlighted in the GFSR. We then go on to talk about more broader transmission channels. We looked at direct exposure to Russia and also we looked at the exposures to Russia, but also the impact for asset management firms or in EMs. Like Tamarah had mentioned, we also looked at the issue of cryptization. And then, of course, we picked on the energy security concerns and the impact on climate transition as one of the key areas. So it is a complicated trade-off amid a whole group of uncertainties. Key takeaways from the GFSR really, in many ways echoing what's in the FSR, that financial stability risks have increased, the balance of risk to growth have tilted to the downside. Inflationary pressures, of course, have increased across the board, requiring decisive monetary policy action, which implies a complicated trade-off for central banks. And in emerging markets, the risk of differentiation is much more pronounced, much higher risk of capital flows in EMs and developing countries. And then the Chinese situation further complicates the scenario where existing vulnerabilities around the property sector remain. But of course, the growth slowdown against a backdrop of the resurgence of COVID is a big concern. And then, of course, as I mentioned, several medium-term challenges around energy security. Let me move on and elaborate on some of these very briefly. Let me begin by looking at the issue of our assessments on global financial conditions. As the chart on the left shows, the global financial conditions have actually tightened meaningfully this year. We've seen the decline in corporate valuations, bond yields, and of course the monetary policy tightening pathway, resulting in a notable tightening in advanced and developing economies. However, when you look more closely at the financial conditions index, the relative to historical levels, advanced economy financial conditions still remain overall roughly neutral. The impact has probably been greatest for emerging markets, especially those which are closer to the conflict. You can see some sharp rises in Central and Southern Europe on the chart, which does not actually include Russia or Ukraine actually. There's been some euro area tightening, but still loose by historical standards, and the same goes for the US. The chart on the right shows that there are significant downsides to the outlook, again echoing what John and Tamarah have mentioned in the FSR. Looking at the global financial stability risks, our growth at risk model, which links financial conditions to the distribution of future GDP growth outcomes, shows that the balance of risk to growth this year remains skewed to the downside. If I move on to the next slide, which shows the risky assets, and as you can see, risk assets have experienced heightened volatility with, I would say, investors oscillating really between optimism and fears. As you can see in the right chart, after some initial deterioration risk assets, global equities have recouped some of their losses. Although when you look more deeply, there are meaningful differences across sectors. Obviously, energy-intensive sectors have been hurt by surging energy and metal prices, but there are differentiations. And when you look at the middle chart, that clearly shows that the heightened uncertainty about monetary policy path and the fears of a recession scenario has led to a dramatic sell-off in the equity markets, and particularly in the US, where some indices are already showing bear market territory. And then when you look at the right chart, that shows the global credit spreads have widened, surpassing pre-pandemic levels. And again, as you can see, the increase has been most evident for the lowest rated firm and riskiest countries. If I move on against the inflation pressures, and inflation pressures, of course, are building up, across the board, as we can see. In the context of the US, we did some work on decomposition of the rates, and when you look at the advanced economy nominal bond yields, you can see the move has reflected both an increase in break-evens as well as real rates, and the rise in inflation pricing following the sudden increase in commodity prices in many ways has been the primary driver, particularly in Europe and the UK. In the US, the yield curve has flattened substantially. The chart in the middle shows that inflation break-evens have risen sharply, especially the 5-year horizon, while inflation expectations on long term remain mostly well anchored. In emerging markets, as you can see from the right chart, risks have increased mainly amid higher food prices, and inflation has continued to surprise on the upside, and in several cases has remained above target. And although EMs were earlier in tightening and front-loaded, and there's an expectation they'll come back to target, but there are some exceptions. Asia is an exception, for example, but you're beginning to see inflation picking up there as well. If I move to the next slide, slide 6, essentially what you can see, and I won't spend too much time here, is that there is a consistently higher pricing in markets. Markets, what you can see is what is being priced in markets is much tighter than what was priced earlier, and with the forward path for monetary policy now much higher everywhere. It's all moved higher, both in the US, the ECB numbers show that, and then of course the emerging markets, you're seeing that as well. Let me move on now to slide 7, and when you look at the normalization of central banks' balance sheets in the US, of course, I mean, I suppose central banks are trying to manage a soft landing while battling in inflation, high inflation at the same time. As you can see that the inversion of several parts of the Treasury curve has raised investors' concerns about the effects of an economic recession. And on the left side, we show some model in terms of the estimation that a rapid unwind of risks of a sudden decompression of the term premium, what impact that can have. But I think the right chart is instructive. It just goes to show the Fed is in a really difficult position to manage a soft landing. As you can see, the chart shows that the effective Fed funds rate along, with the spread between the 10-year and 3-month yields shows that recession periods are shaded, and during periods of high inflation, the Fed fund rate is colored red here, and during periods of high inflation, the Fed funds line, as I said, is colored red, and therefore an inversion of that has been, if you look at this chart, which our financial counselor Tobias Adrian has often used, it shows that it does act as a predictor of an upcoming recession, and so in many ways, although our baseline is that there will be a soft landing, but there are clearly lots of downside risks around this forecast. So we thought I would share that with you. If I move on to the next slide, clearly again the FSR has talked about this euro area. The ECB write-up has already identified this. It's a complicated trade-off again, bringing back inflation to target while managing fragmentation risks. This is clearly the first order, and again in the GFSR, if you can, this is again presented in our GFSR in April. As you can see from the left, spreads have widened since we published the GFSR, and again as fragmentations as risks, I suppose, remain very much in focus. But again, the FSR has clearly warned that financial fragmentation could emerge as well, which is very prescient. We look at the Russian exposure when we did the GFSR in the next slide. When we did the assessment here, again, echoing what came through from the FSR, we looked at other propagation channels of the war. And again, when we looked at direct exposure of foreign banks to Russia and Ukraine, they seem to be modest in the context of the overall size of exposures. In total, it's about 120 billion, with about 60% in foreign currency. It was the indirect exposures which I think we felt were more difficult to quantify due to the absence of detailed disclosures. And the middle chart shows that, again, some forex derivative exposures of foreign dealer banks to Russia are significant, fairly contained in a sense, but nevertheless, there were still some unknowns here. And then again, we did identify some of the implications for the corporate sector in the right-hand side chart. On emerging markets, the GFSR in the next slide talks about the risks in emerging markets. Clearly, the spillover effects of the war to the emerging and frontier markets was pronounced. The first signs of differentiation across countries had emerged, and we saw this in the context of some of the weaker issuers. And here we saw that there were some, many countries in distressed territory, and several of those were hit. Those are certainly areas of risk for us. And then we looked at the tighter financial conditions, which is likely to increase downside risk for emerging market portfolios. And our model of capital flows at risk shows that the range of potential outflows is likely to be higher. Let me turn now to the slide 10, which is on the vulnerabilities in China. I think basically this really shows that the COVID-19 outbreaks have tilted the balance of risk to the downside. The financial vulnerabilities in the property sector remain elevated, and these are areas of concern. And perhaps I'll move on in the interest of time to the final slide, which really is around the climate change transition issues. I think in this context, while the invasion of Ukraine has brought to the fore several medium-term challenges, one of which we highlighted is the concerns about energy security around the world, with the perception of the trade-off between energy security and the need to transition to renewables changing as a result. And clearly, Europe has relied on Russia for a significant portion of its needs. And again, as you can see, some of the reinforced these points about the transition challenge. Stocks tied to clean energy have actually underperformed recently, despite strong investor demand in the past. So we sort of show that. And I think the final slide, which we finish off with, are several of the policy recommendations, which again echo some of the points that were made in the FSR. So I will stop there. Thank you very much.
Thank you very much, Ranjit, for this comprehensive overview, also of a global assessment. Now, I'm aware we're a couple of minutes over time already, but I would still want to give John and Tamarah the opportunity to reply to some of the points that were made.
Thank you very much for that, Ernest. And let me thank each and every one of the discussants, Stefan, Patrick, and Ranjit. I mean, it's terrific to get such feedback from such recognized financial stability experts as yourselves. I mean, I think I can't really go through all of the points that you have made. Together, I think you have given us basically a work program for the next couple of years of issues that we could look into from a financial stability perspective. I mean, maybe one thing that I could say is that the our FSR has tended to focus on a kind of a short to medium term horizon, so kind of 18 months, 2 years, 3 years, something like that kind of horizon. And I recognize, though, that some of these longer term issues that I think was a common theme running through the points made by all three of you are becoming more and more important. So I mean, the whole issue of supply side shocks. I mean, COVID, of course, reminded us of the supply side. I think climate change was already reminding us of the supply side anyway, and now we also have the war as well. And all of this is kind of coming together in a way that that we can see that economies we're in a kind of a process of transition, which of course we have to take into account in our financial stability assessments going forward. Our Vice President has often been saying that the peace dividend that had supported some of the structural forces that were behind, for example, low interest rates and low inflation is gone, you know, with the war in Ukraine, and that, you know, we have to think about, you know, we're going to see things like shifts from increased military spending, moves towards energy independence, and all these things as well that I think you were kind of touching upon. Near term, I think, if I'm not mistaken, I think all three of you kind of touched on this snapback risk, and I think it's right. I mean, it's there. It is there. We admit that it's there. If it's not so prominent in the FSR, it doesn't mean that we're not aware of it. That, you know, of course, and we have seen it in the past, that you know, market dynamics can get out of hand. I mean, so far so good. I mean, we've been watching a relatively orderly correction, but it doesn't look like it's over yet. To me, so there's more adjustment to take place. I don't know if Tamarah wanted to add anything.
Not particularly. I mean, also just to echo the thanks for diligent consideration of the points and coming back to us with food for thought. I think one of the things, just on the snapback point, I think Ranjit had the slide. You had the slide on financing conditions, and in fact, one of the debates that we don't get into the FSR, but I think we need to think about is how should we think about financing conditions with this kind of cost inflation shock. So I think when John presented on debt sustainability, we know we need to discount for inflation, but when you've got a cost shock with inflation, what's the right deflator to think about for financing conditions? And I think that's going to be something we need to continue to reckon with in coming months, as we're probably going to watch policy rates start to move, and then where do we end up? So I think it's actually quite a challenging one, especially for people like me, probably who've not seen an inflation shock like this before in my professional career. And then also points are really well taken also on the external sector. This in the euro area, often something we haven't given too much attention to in recent financial stability reviews because of a closed current account position, so it's not something that comes front and center, but I think points were made regarding EMEs and the situation that they face, and then also with global currency movements. I think it's something we would definitely put on the list to come back to, so thank you.
Thank you very much, Tamarah. Now, this brings us to the end of this webinar. Thank you very much to John, Tamarah, Stefan, Patrick, and Ranjit for sharing your insights with us, and to all of you for your interest. With this, let me close. Thank you again. Bye-bye and take care.
Thank you.
Thank you. Goodbye.